All right, let's dive in. Today we're taking a deep dive into Common Stocks and Uncommon Profits by Philip Fisher.
Oh, yeah, this book.
It's a classic for a reason, right?
Absolutely a class.
We're going to explore some of his key ideas and kind of see how they play out in today's market. Help you see how you can apply them right now.
Yeah, what's fascinating about Fisher is that he wasn't, into quick wins or chasing fads. I mean, remember, he was writing back in the 50s and 60s.
Yeah.
But his focus was on finding those companies that just keep winning over time. It's the kind of approach that can turn, say, 10 grand into a hefty chunk of change. We're talking 40,000, maybe even 150,000 in a decade.
Whoa, that's serious growth.
It is.
That's the power of compounding, right? And Fisher was all about it.
Yeah.
He had these 15 points.
Yeah.
Not hard rules, but think of them as clues to spot businesses that have that staying power,
Right.
And one that really caught my eye is profit margin. He didn't see it as just a number, did he?
No, not at all. He saw profit margin as a window into how efficiently a company turns sales into actual profit. And that profit, that's the fuel for future growth.
Yeah.
So if a company consistently has, a healthy profit margin, you can bet they're well managed and have that pricing power, which are both crucial for long-term success.
Right. Okay. So healthy profit margins are a good sign.
Yeah.
So what else should we be looking at?
Well, Fisher, he was obsessed with a company's approach to research and development. He saw it as, where the future is born, where innovation happens.
Right.
But he cautioned that it's not just about the amount spent, it's about how effectively that money is used. He points to Dow Chemical as a great example. Their success wasn't just about breakthroughs in the lab, it was also about things like meticulously training their sales teams so they could actually explain the value of those innovations to customers.
That makes sense.
Yeah.
So it's not just creating something new. It's also about being able to communicate that value to the people who are going to buy it.
Absolutely, yeah.
So how did Fisher actually go about figuring all this out, though?
Yeah.
Was he just reading company reports all day?
No, not quite. He had the super interesting method called scuttlebutt.
Scuttlebutt.
Think of it as being a business detective.
Oh, interesting.
Fisher believed that the most valuable insights often come from sources beyond the company presentations and reports. He was all about talking to everyone. Competitors, customers, suppliers, anyone who could offer a unique perspective on the company's, culture and operations.
I love it. It's like building a complete picture of the business by gathering all these different pieces of the puzzle.
Exactly.
It sounds very hands-on.
Yeah, very much so.
Did Fisher have any personal anecdotes about how he actually used this scuttlebutt method?
He did. One that comes to mind is how he'd take his friend, Professor Emmett, on these drives to visit various companies.
Okay.
But the real magic happened on the ride back.
Uh-huh.
Professor Emmett would share his raw, unfiltered impressions of what he'd seen and heard. And these conversations were gold for Fisher, giving him these incredible insights that you just wouldn't find in a company's polished reports.
That's so cool. So scuttlebutt is all about piecing together information from all sorts of sources.
Right.
But what about interpreting that information?
Yeah.
Do Fisher have any advice on how to actually make sense of it all?
Absolutely. Fisher was very clear that you can't take any single opinion as, gospel, right? You have to weigh different viewpoints, consider the biases of each source, and then synthesize it all into your own judgment.
Right.
In other words, it's about gathering information and then thinking critically about it.
Yeah, it's not just about finding the information. It's about thinking for yourself and making your own informed decisions.
Exactly.
I like that. What else was he big on?
Well, one thing that might surprise you is Fisher's skepticism of the efficient market hypothesis.
Oh, interesting.
That idea that stock prices always perfectly reflect all available information.
Yeah. I've always thought that was a bit too neat and tidy. Markets can be pretty irrational sometimes, can't they?
Exactly.
Oh.
And Fisher believed that the market could misjudge a company's prospects, which creates opportunities for savvy investors to find those, hidden gems. He uses Raychem Corporation as a prime example.
Okay.
This company was upfront about facing some temporary challenges, but they also highlighted their bright future prospects. But guess what? The stock price didn't budge. It didn't reflect the company's true potential, proving that the market isn't always as efficient as some people claim.
Right. So even if a company's open and honest, the market might not get it right away.
Yeah.
That's fascinating, and it seems like that would create opportunities for investors who are willing to, dig a little deeper.
For sure.
Did Fisher have any specific criteria for evaluating a company?
He did. He talked about these three dimensions of a conservative investment. The first one is all about a company's core operations, their products, their competitive landscape, how they actually make money. Basically, it's about understanding the nuts and bolts of the business.
Gotcha. So that's dimension one,
Yeah.
the company's core operations and their potential for future growth. What about the second dimension?
Dimension two shifts the focus to the people running the show.
Okay.
It's about the quality of the leadership, their vision for the future, their ability to attract top talent, adapt to change, and build a strong culture. Essentially, you're trying to get a feel for the company's soul.
Hmm.
Are they good people making good decisions?
It made sense that Fisher would emphasize the importance of leadership. After all, great companies are built by great people. What about the third dimension?
Right.
What's that all about?
The third dimension looks at those inherent characteristics of a business that give it a lasting edge over competitors. We're talking about things like strong brand names, unique technologies, and clever distribution networks.
Okay.
It's like discovering a company's secret sauce.
All right, so the three dimensions are about the core operations, the leadership, and the unique advantages of the business. That seems like a pretty holistic way to evaluate a company.
Yeah.
And it's all about understanding what makes a company tick, what gives it the potential to succeed over the long haul.
For sure.
But we're only just scratching the surface here. There's a lot more to Fisher's philosophy that we need to explore.
Oh, yeah, absolutely. One of the things that makes Fisher so interesting is, how he understood that investing is as much about psychology as it is about numbers.
Yeah.
He recognized that emotions like fear and greed can really mess with the market, like driving things to extremes.
Right.
And that creates both risks and opportunities for those who know how to navigate those currents.
He was writing way before behavioral economics became a thing, but it sounds like he was really onto something.
Yeah, he was.
So how did he think investors should deal with those emotional swings?
Yeah,
Did he have any specific advice?
he did. One of his biggest pieces of advice was to never let those day-to-day market ups and downs dictate your long-term strategy. He was adamant that you should focus on a company's fundamentals, not their stock price, to make clear-headed decisions.
Yeah.
Think of it like tuning out the noise to focus on the actual signal.
Yeah, it's easy to get caught up in the hype, especially when you see a stock soaring or plummeting.
For sure.
But focusing on the underlying business makes a lot of sense.
It does.
Did he talk about any other psychological traps that investors should watch out for?
Yeah, he warned against getting too obsessed with avoiding mistakes.
Okay.
He believed that being too risk-averse can actually cause you to miss out on big opportunities.
Right.
To him, well-researched, calculated risks are essential for big rewards.
So it's about finding that balance between being careful and being bold.
Yeah.
I like that. Did Fisher have any thoughts on how long investors should hold on to their stocks?
Fisher was a big believer in holding on to winning stocks,
Uh,
even if they had already gone up a lot.
Right.
It goes back to his analogy about selling your contract with a promising classmate. He saw selling a great company just because its stock price has risen as selling a winning lottery ticket before you even check the numbers.
It's like you're giving up on future gains just because you're a little scared of losing what you've already made.
Right, exactly.
But what if a company's fundamentals start to change? Would Fisher say it's time to sell then?
That's a great question. Fisher would say that as long as a company's core strengths are still there and they have solid growth prospects, there's no reason to panic just because the stock price gets a bit ahead of itself.
Right.
It's about having conviction in your research and not being swayed by the market's, mood swings.
So it sounds like patience is a big part of Fisher's approach.
Definitely.
You've mentioned his skepticism about the efficient market hypothesis, which is all about how stock prices supposedly reflect all available information.
Yeah.
But if that were true, wouldn't it be impossible to outperform the market?
That's exactly what Fisher argued against. He believed that some businesses are just fundamentally better at making money than others. And it's up to the investor to identify those companies. It's not just about finding a company with a hot product. It's about understanding why that company is successful and if that success is sustainable.
So it's about digging beneath the surface and understanding the real drivers behind a company's performance.
Exactly.
What kind of factors did Fisher think gave companies a lasting advantage.
He highlighted things like strong brand names, proprietary technology that's tough to copy, and unique distribution networks.
Uh-huh.
These are the things that make it hard for competitors to catch up, and give a company that long-term competitive edge.
So these are the companies that can weather the storms and come out stronger on the other side.
Yeah,
Did Fisher have any thoughts on the importance of a company's sales organization?
he did. Fisher believed a strong sales force is a major advantage, especially in industries where it's hard to make your product stand out from the crowd. I mean, even the best product won't sell itself, right?
Right, that makes sense. If you can't get your product in front of customers and explain why it's better, you're not going to get very far.
It's exactly.
What about a company's ability to change and adapt?
Yeah.
Did Fisher have any opinions on that?
He was very big on that. He understood that the world changes constantly, and businesses that can't keep up are doomed to fail. He saw a company's willingness to innovate, try new things, and adapt to new challenges as essential for long-term survival.
So it's not just about finding a company that's doing well right now. It's about finding a company that's capable of evolving and succeeding in the future.
Right.
I know a lot of investors are talking about ESG investing these days, environmental, social, and governance.
Yeah.
Did Fisher ever address anything like that?
That's a really interesting question. ESG wasn't really a thing back when Fisher was writing,
Right.
but a lot of his ideas actually line up with what ESG is all about. His emphasis on ethical leadership, treating employees well, and building sustainable businesses aligns really well with the social and governance aspects of ESG.
It sounds like he was ahead of his time in a lot of ways.
Yeah.
But even if he didn't use the term ESG, it seems like his focus on finding well-managed companies with strong values is very much in line with that philosophy.
Exactly. And while he didn't explicitly talk about environmental issues, his focus on the long-term sustainability of a business certainly implies a concern for environmental impact as well.
Right.
Companies that disregard the environment are unlikely to be around for the long haul.
Okay, so we've talked about a lot of Fisher's 15 points.
Yeah.
But are there any specific points that stand out to you as being especially relevant in today's market? Ones that you find particularly interesting or maybe even challenging?
There are a few that really jump out at me. One is his point about executive depth and development.
Right.
In today's world, things move so fast that having a strong bench of leaders is more critical than ever.
Yeah.
It's not just about the CEO. It's about a company's ability to cultivate talent and ensure a smooth transition when leadership changes. Fisher's example of Motorola's Executive Institute is a great illustration of how to do this right.
That's a really interesting point. It's not something you hear a lot about, but it makes a lot of sense. It's like investing in your future leadership pipeline.
Exactly. And another point that feels super relevant today is Fisher's emphasis on a company's long-term outlook.
Yeah.
It's so easy to get caught up in quarterly earnings and chasing short-term gains.
Right.
But Fisher was all about finding companies that were willing to invest today for a better tomorrow, even if it meant sacrificing some immediate profits.
It's like that famous quote from Warren Buffett about someone sitting in the shade today because someone planted a tree a long time ago.
Exactly.
It takes vision and discipline to play the long game like that.
Absolutely. And this ties into another one of Fisher's points that I find really interesting, his warnings about the dangers of too much debt. It's tempting for companies to load up on debt to grow quickly or make big acquisitions, but that can make them very vulnerable, especially when the economy takes a downturn.
Right.
Fisher was all about companies with strong balance sheets and a conservative approach to debt.
Yeah.
He saw that as a sign of strength and resilience.
So it's not just about how fast a company is growing. It's about how sustainable that growth is.
Right.
I like that. What else stands out to you?
Fisher's emphasis on research and development is another one that I find really compelling. He was a big believer in innovation, and he saw R&D as the engine of future growth. His example of Dow Chemical, which we talked about earlier, is a great illustration of how a commitment to R&D can lead to real-world success.
It seems like he was looking for companies that weren't just trying to keep up with the times, but were actually pushing boundaries and creating the future.
Exactly. And he didn't just focus on the dollars spent on R&D. He was interested in a company's overall culture of innovation. He believed that the best companies weren't just throwing money at research. They were creating environments where creativity and experimentation were encouraged.
So it's about more than just the numbers. It's about a company's mindset and their commitment to progress.
Yeah.
Yeah. One thing that strikes me as incredibly relevant in today's world of social media and influencers is Fisher's emphasis on the integrity of management. With so much information out there, it can be hard to know who to trust.
That's such a good point. Fisher was adamant about avoiding companies that were secretive or dishonest.
Right.
He believed that transparency, honesty, and ethical leadership were essential for building trust and creating a truly sustainable business.
And his point about avoiding companies that clam up when things go wrong feels even more relevant today with companies constantly in the spotlight.
Yeah.
It's about finding companies that are willing to be open and honest, even when it's tough.
Exactly. It's about admitting mistakes, learning from them, and striving to do better. Because ultimately, trust is the foundation of any strong relationship, whether it's between a company and its investors or a company and its customers.
Fisher believed that companies that were transparent and honest were more likely to build those long-lasting, valuable relationships.
Yeah.
It makes you think, what aspects of Fisher's approach might we want to question or challenge?
Mm.
It's one thing to admire his work, but it's another to blindly accept every single idea. Did you find yourself doing that at all?
It's important to approach every investment philosophy, even one as respected as Fisher's, with a critical eye. One thing I sometimes wonder about is his unwavering focus on growth.
Okay.
Growth is great, don't get me wrong, but I do wonder if there's a point where a company can get so big that it loses its agility and innovative edge.
That's a really good point.
Yeah.
It's almost like a paradox.
Right.
A company's success can sometimes lead to its downfall if it becomes too bureaucratic or complacent.
Exactly. And I think that's a valid concern, especially in today's rapidly changing world. Sometimes smaller, more nimble companies can outmaneuver the giants.
Right.
Another thing that gives me pause is Fisher's aversion to diversification.
Okay.
While concentrating your investments in a few carefully chosen companies can lead to amazing returns, I think there's also a strong case for diversification, especially for individual investors.
Right. It's all about balancing risk and reward.
Yeah.
And even with the most thorough research, you can't eliminate all risk.
Nope.
Having a basket of different companies can help cushion the blow if one of your investments doesn't pan out the way you hoped. It's like that old saying about not putting all your eggs in one basket.
Exactly. So while I admire Fisher's conviction in his approach, I think it's wise for most investors to diversify to some extent.
Right.
It's about finding that sweet spot between concentrated bets and spreading yourself too thin.
Yeah, investing is a continuous learning process.
It is.
You have to be willing to adapt and refine your approach as you gain experience and knowledge.
Oh, sure.
And that's what makes it so fascinating.
I completely agree. It's not just about following formulas or blindly trusting experts. It's about developing your own judgment and making informed choices based on your individual circumstances and risk tolerance.
You know, it's amazing how relevant Fisher's ideas still are today.
I know, right?
Even though he was writing, what, like decades ago?
It's true.
It really speaks to how well he understood human nature
Yeah.
and those core principles that make businesses successful over the long haul,
Yeah.
you know?
Yeah, I think one of the things that makes Fisher so valuable is that, like, he doesn't give you this rigid set of rules. Instead, he provides you with, like, a framework for thinking about investing.
Yeah.
It's like he's handing you a set of mental tools and saying, go explore.
He definitely wasn't afraid of hard work and thorough research, that's for sure.
Oh, yeah.
He believed in getting information from all sorts of sources, not just relying on the company's official story.
Right.
That scuttlebutt method we were talking about earlier really highlights that.
Absolutely. It was all about going beyond those polished presentations and digging deeper, talking to competitors, customers, suppliers, industry experts, anyone who could offer a different perspective.
Yeah.
It's like piecing together a puzzle to get a clearer, more complete picture.
And that takes time and effort.
It does.
But Fisher believed the rewards were worth it.
Oh, absolutely.
He wasn't interested in quick profits.
No.
He was all about finding those exceptional companies that could just keep growing for decades.
For sure. It does take patience and discipline, and you have to be willing to think for yourself. Which brings us to another important aspect of Fisher's philosophy.
Right.
His contrarian nature. He was skeptical of conventional wisdom and always ready to challenge assumptions. He wasn't afraid to go against the crowd.
He famously said, "The stock market is filled with individuals who know the price of everything but the value of nothing."
It's so true.
It's so true. People get caught up in the hype and forget to look at the underlying business.
Yeah. Fisher believed that the crowd was often wrong, and that the best opportunities were found by being a bit of a contrarian. Of course, that takes courage and conviction.
Yeah.
You have to really believe in your research and not be swayed by what everyone else is doing.
Fisher's ideas are all about empowering individual investors
Absolutely.
to think for themselves, do their own research, and make their own decisions.
Yeah.
It's not about blindly following the herd or relying on so-called experts.
Right, and that's what makes investing so fascinating. It's a journey of discovery and continuous learning.
Uh-huh.
It's about developing your own judgment and making informed choices based on what you've learned.
So as we wrap up this deep dive into common stocks and uncommon profits,
Yeah.
what's the one key takeaway you want our listener to walk away with? What's the most important thing to remember?
That investing is not a destination, it's a journey.
Yeah.
It's about constantly learning, adapting, and refining your approach as you go.
And that journey begins with a solid understanding of those fundamental principles that drive business success and create long-term value.
For sure. Fisher's 15 points are a great place to start.
Yeah.
They give you a framework for evaluating those fundamentals and identifying companies that have the potential to be truly great.
And his scuttlebutt method reminds us to, go beyond the surface, to
Yeah.
gather different perspectives and form our own independent judgments.
Most importantly, Fisher teaches us that investing is not just about numbers.
Right.
It's about people, their stories, and those unique qualities that make a business truly exceptional.
And that's what we're all about here on The Deep Dive, exploring those stories, uncovering the insights that can help us make sense of the world of investing.
So until next time,
Yeah.
keep learning, keep exploring,
Keep diving deep.
and keep diving deep.